Welcome to the InnoGuide podcast, where we share the works of authors and mentors to guide innovation. I'm your host, Bob Boudelier. This podcast, my website, my newsletter, and my community are focused on helping you discover the secrets of innovation in the age of AI. Since I don't rely on paid ads, I want to thank customers who bring me into their programs as a technical product accelerator to work alongside their teams, helping them develop products smarter and faster without adding risks while bringing human-centered AI into their organization. You can learn more at www.innoguide.net. In this episode, number 101, we'll be sharing The Secrets of Sand Hill Road by Scott Kupor. After sharing Incorruptible last week by Eric Ries, I decided I should share this book, which goes into deep detail about how to set up a startup and what all the players are looking for in that venture capital food chain when you're trying to get financed. It's important to know all the backstory and know how to read the documents that you may get handed as a founder or as someone in a company that is in a more advanced state. You may not be looking for a seed round, but looking for an A or a B round. And I've worked with companies that secured $44 million for an E round. So, without further ado, let's get started. Scott opens with this. I'm speaking to you from my office on Sand Hill Road in Silicon Valley. Though I want to be clear from the start, this isn't some sermon handed down from on high. Venture capital is far too nuanced a field for that. There are countless firms investing at different stages with different philosophies, portfolio strategies, and personalities. Every entrepreneur and company is equally unique, bringing their own set of opportunities and challenges to the table. He says he comes to this book with two significant biases that have shaped his thinking. First, he's lived through the startup experience firsthand at LoudCloud and Opsware. And second, since 2009, he spent time as a managing partner at Andreessen Horowitz, giving him the privilege of seeing venture capital from both sides of the table. That dual perspective, having sat in both the founder's chair and the VC's chair, has taught him something fundamental. Entrepreneurs and VCs shouldn't think of themselves as opposing sides. They're partners with a shared mission to build meaningful businesses that improve the world while creating financial returns. He wants to be direct about what venture capital actually is. He says, we raise investment funds from limited partners like endowments, foundations, and pension plans that invest that capital in entrepreneurs with breakthrough ideas. They operate across the entire spectrum from pre-revenue startups to growth stage companies, staying engaged for 5 to 10 years or longer, supporting multiple funding rounds, sitting on boards, and doing whatever they can to help the company succeed. But this is what's critical. Writing the check is just the beginning. The real world happens in the daily grind of company building, and that's on the entrepreneurs and their teams, not the investors. The numbers speak for themselves. A 2015 Stanford study found that 42% of all U.S. IPOs since 1974 were venture-backed. That's almost half. Those companies have invested $115 billion in R&D, accounting for 85% of all R&D spending, and created $4.3 trillion in market cap. Young startups were responsible for nearly all net jobs created since 1977. So, what's the reason he's writing the book? He feels there's a fundamental imbalance in this industry to address. VCs get multiple investment opportunities throughout their careers, while most founders only get a few chances to build companies. This creates an information asymmetry that often leaves the founders at a disadvantage when they're negotiating with repeat player VCs who really understand the mechanics of term sheets and financing. The truth many founders don't realize is that raising venture capital isn't a one-time transaction. It's entering into a minimum 10-year marriage with your VC partners. Yet despite this lengthy commitment, there's surprisingly little transparency about how the partnership actually works. So his goal is to help entrepreneurs understand how VC capital works, how venture capital works, so you can make informed decisions about whether raising VC is right for your business. He wants to level the playing field by pulling back the curtain on the complete VC lifecycle. How VC firms form and operate, how startups structure themselves, the critical financing process and term sheets, board dynamics once funded, and how money returns to investors through exit. Understanding this full circle helps founders anticipate VC behavior and determine whether venture financing aligns with their goals. Because when incentives align, magic happens. But you need to understand what motivates VCs and what constrains them before committing to that partnership. The book is not comprehensive. Academics and seasoned professionals dedicate careers to these topics, but it provides practical insights into why VCs do what they do, ultimately creating better company building opportunities for everyone involved. So Scott starts off by telling us who he is, how he got here, because his journey into VC is a bit unconventional. Things had gone differently, he'd probably be playing country music in Nashville right now, he said, instead of wearing cowboy boots in the office in Silicon Valley. To understand where he ended up, you need to understand the world he stepped into during the 1990s. Late 90s were absolutely euphoric. Companies like Epiphany, NetIQ, and VA Linux were riding a wave of pure excitement. Netscape's 1995 IPO had kicked off the dot-com fever, and by 1999 the frenzy was at a fever pitch. That year alone, roughly $36 billion flowed into startups, double the year before. Limited partners committed over $100 billion to venture capital, a record we've never come close to repeating. The metrics were insane. Companies were hitting IPOs in about 4 years instead of 6 or 7. The NASDAQ peaked at 5,000 in March 2000 with a PE ratio of 175, meaning investors were valuing $1 of earnings at $175. That was completely detached from reality. Cisco was expected to become the first trillion-dollar company, and Amazon was valued at $30 billion. Boy, how things have changed. Then it all collapsed. NASDAQ plummeted 80% by August 2002, hitting just above 1,300. That's a drop of 75%. The Federal Reserve's aggressive interest rate hikes created real questions about this massive tech infrastructure, spending binge, and suddenly everybody was focused on survival. He said, I was largely oblivious during my time at Stanford and law school. After clerking in Houston, I joined Lehman Brothers, helping life science companies raise capital. Not glamorous during a tech boom, but it worked for him until his friends moved to Credit Suisse. First Boston changed everything. When a marketing executive told him about joining a startup called LoudCloud, co-founded by Mark Andreessen and Ben Horowitz, he couldn't resist. His pregnant wife thought he was crazy to leave a thriving investment banking career for stock options and minimal salary, but Mark's napkin sketch at a Denny's interview sold him on the vision, turning computing into a utility the way Amazon Web Services eventually did. The execution, though, was anything but elegant. They targeted startups as customers, thinking they'd naturally outsource their infrastructure management. But they had to buy massive amounts of data center space up front, betting that they'd recoup those costs as their customer base grew. When the dot-com bubble burst, the startup customers began failing, and they were left holding big, enormous fixed infrastructure costs while their revenue base evaporated. With VCs no longer writing checks, they needed buyout investors or an IPO, and they chose to go public at $6 per share. Not ideal, but gave them enough capital to survive. In 2002, they sold most of LoudCloud to EDS, kept the internal software they developed, and rebranded as Opsware and essentially started over. The stock bottomed at 34 cents, but they persisted. 5 years later, HP acquired them for $1.65 billion. After that exit, he ran HP's global software support business. Then Mark and Ben began angel investing seriously. They were investing at a pivotal moment. The VC industry had been controlled by a small number of powerful firms since the 70s, but two major shifts were underway. Startup costs were declining dramatically thanks to cloud computing, and Y Combinator was demystifying the startup process for entrepreneurs. This knowledge democratization fundamentally shifted power toward founders. Mark and Ben recognized that access to capital alone would no longer differentiate VC firms. So they founded Andreessen Horowitz in 2009 with a radical thesis: provide something beyond capital. Back technical founding CEOs and build a network of people who could help product visionaries become world-class operators. Throughout the book, Scott is committed to honoring the entrepreneurial journey, recognizing that while the odds of success are genuinely small, the ventures that succeed share vision, inspiration, grit, and luck. Here's a fundamental truth. Startups live or die based on their access to venture capital, and VC funding works best when it's a true partnership. entrepreneur and VC are genuinely aligned. But when those interests diverge, things get uncomfortable, and that's why the best partnerships level the playing field. Everyone needs to understand how VC actually works, not the romantic version, but the real mechanics. That understanding prevents misalignment and friction down the road. So that's what he's getting into in this book. When most of us think of venture capital, we think of it as a source of financing for technology startups. And that's true in many cases because VC has funded some of the most successful tech companies in history: Facebook, Google, Amazon, Apple, and Netflix, to name a few. In fact, all 5 of the largest market cap companies at the time of this publication were VC backed. It's remarkable when you think about it. But what might surprise you is that not all venture funded companies are tech companies. Staples, Home Depot, Starbucks, Blue Bottle Coffee all got VC funding. So what really is the distinguishing factor for venture capital? At its core, VC is equity financing for companies that don't fit traditional bank lending criteria. So he explains the fundamental difference like this. Banks have historically been the primary source of startup capital through small business loans, but loans require regular repayment with interest. So they're best suited for businesses generating positive cash flow. Equity financing is different. There's no obligation to repay it. Instead, investors bet that the company's equity value will grow, expecting eventual returns by eventually selling their stake. The choice between debt and equity comes down to your business model. If you can generate cash flow quickly, bank loans let you retain complete control. But if you need to reinvest all your cash into operations, or you face high risk or require long development periods before being profitable, equity financing makes more sense. What's the trade-off? You give up ownership and accept investor involvement in major decisions. So here's something that might sound counterintuitive. Venture capital is actually not a great investment for investors. Median 10-year VC returns in 2017 were significantly below the NASDAQ, yet capital remains tied up for years with limited liquidity. Why is this? Because VC returns don't follow a normal distribution. They follow a power law curve. A small percentage of firms capture disproportionate returns, so most VC firms underperform. Concentration of success comes down to signaling. Top-tier firms develop reputations that attract the best entrepreneurs, engineers, and business partners. Success breeds success. Past victories signal competence, creating a self-fulfilling prophecy where dominant firms keep winning across multiple fund cycles. So, what's the critical insight about how VC succeeds? The best VCs don't have the highest batting averages. Think of it this way. Roughly 50% of VC investments are losers. They lose money. Another 20 to 30% return just a few times the investment. This leaves only 10 to 20% as true home runs. Returns of 10 to 100 times the invested capital. What actually matters isn't the batting average. It's at-bats per home run. A VC with 40% overall batting average but exceptional home runs outperforms one with 60% hits and mediocre tops. Accel Partners made 1,000 times its money on Facebook. Everything else they did in that fund was almost irrelevant to their performance. You can't de-risk your way to success in venture capital. Top-performing funds often have worse batting averages than underperformers because they're swinging for the fences, not bunting for singles. So he paints this bigger picture. Despite being a tiny financial beast, venture capital invested about $84 billion in 2017, less than 0.5% of U.S. GDP. Venture-backed companies absolutely dominate the economy. The 5 largest U.S. companies by market cap are all venture-backed, as we discussed, and a Stanford study found that since 1974, 42% of all public companies are venture-backed, representing 63% of total market capitalization and 85% of all R&D spending, as we said before. The VC industry punches extraordinarily above its weight. You're taking a tiny amount of capital and generating companies that reshape entire industries. That's the real story of venture capital. So here's the reality that early-stage VCs face. The company barely exists. You've got some PowerPoint slides, a founder pitch, maybe a rough prototype. But there's no meaningful financial data. And that's why traditional financial modeling, the kind that assumes you can forecast revenue 5 years out for a company that doesn't exist yet, is essentially useless. We call that garbage in, garbage out. So what do VCs actually rely on? Three things: people, product, and market, and not in equal measure. So let's start with the most critical one. People matter more than anything else. In fact, it's not even close. Here's why. Ideas aren't proprietary. If you've got a good idea, 10 other teams probably have the same idea. So the real question VCs are asking isn't, is this idea good? It's, why back this team over whoever might walk through that door tomorrow? That infinite opportunity cost explains why we practically can't invest in direct competitors. Each investment is essentially saying, this is the winning horse in the race. Getting the category right but picking the wrong horse, that's venture capital's cardinal sin. Friendster versus Facebook is the textbook example. When evaluating founders, we look at a few specific things, he says. First, there is founder market fit. Does this person have unique characteristics suited to this exact opportunity? Martin Casado had a PhD in software-defined networking before starting Nicera. The Airbnb founders had struggled personally to make rent in San Francisco. These weren't accidents. Second, we assess whether the founder can lead. Can they attract great talent, great customers, and future investors? Do they tell a compelling story? Mark and Ben Horowitz once called this quality egomaniacal, and they meant it as a compliment. You need almost delusional confidence to start a company when the odds are this bad. You have to be partly delusional to pursue ideas that look like bad ideas, because obvious ideas could never generate venture returns. Now on product, here's something that might surprise you. We assume the initial product will change dramatically. What actually matters is the founder's idea maze, their thinking process, the insights they've gathered, the market data that shape their current direction. They want founders with strong convictions held lightly. Conviction, but flexibility. Products need to be breakthrough. Ben Horowitz has a great framework: aspirin versus vitamin. Aspirin solves urgent problems. People buy aspirin. Vitamins are nice but easy to skip. Your product needs to be roughly 10 times better or 10 times cheaper than existing solutions. Otherwise, the inertia, institutional inertia, habit, everything, keeps customers with the status quo. And finally, market size. The mantra here is simple: market size, market size, market size. You can execute perfectly, build an amazing product, and still fail if the market's too small to generate venture returns. You can get the company right and the market wrong, and you'll end up with a profitable, capped business that never scales. Estimating market size is straightforward when you're directly substituting for an existing product, but it gets treacherous with entirely new markets. Airbnb's market looked tiny when they were just college students sleeping on couches, but they expanded into new customer segments and actually grew the total addressable market itself. That's how early-stage venture capital works: people, product, market, and when you get all three right, that's when the magic happens. So as part of walking you through the whole ecosystem of venture capital, we have to talk about limited partners. Understanding them is critical to understanding venture capital and why their needs and motivations shape how the whole VC ecosystem operates. First, some historical context. The concept of venture capital isn't new. Queen Isabella of Spain essentially acted as the first true VC when she backed Christopher Columbus with capital in exchange for a portion of future profits. Then fast forward to the 1840s in New Bedford, and you'll find agents raising capital from wealthy people to fund whaling ventures. These early VCs understood something fundamental: asymmetric returns. They risked capital on ventures with uncertain outcomes but massive upside potential. Though 30% of those voyagers lost money, the winners more than compensated. Later, J.P. Morgan financed Thomas Edison's company, even beta testing it in his own home and nearly burning down the house in the process. Today's venture capital exists entirely because of LPs, limited partners, investors who commit capital to VC funds seeking what's called alpha, or excess returns above market benchmarks. If the S&P 500 returns 7% annually, LPs expect 12 to 15% from their VC allocations. Yale's endowment has achieved over 18% yearly returns versus the S&P's 8%. LPs fall into several categories: university endowments like Stanford and Yale, foundations such as Ford and Hewlett, pension funds, family offices managing ultra-high net worth families, sovereign wealth funds, insurance companies, and funds of funds. What unites them all is a mission, generating returns that satisfy specific obligations. Universities need endowment income to cover 30 to 50% of operating expenses. Foundations must earn enough to fund perpetual charitable giving while meeting required 5% annual payouts. The real enemy for all LPs is inflation, whether it's salary inflation at universities or healthcare cost inflation at pension funds. Rather than betting everything on venture capital, sophisticated LPs build diversified portfolios. Yale's endowment under David Swensen exemplifies this approach, transforming into a sophisticated model that now manages $25 billion and contributes $1.15 billion annually, roughly one-third of Yale's total operating budget. Here's what makes this relevant to you as an entrepreneur or as a business owner. Yale uses a smoothing model to manage spending, committing about 5.25% annually. If inflation runs 2% and they need to distribute that much yearly, Yale requires at least 7.25% gross returns just to break even. If they accomplish this through an allocation that's dramatically overweight in illiquid asset, 50% of the portfolio, with venture capital receiving a whopping 16% allocation compared to a 5% average among peer endowments. Why? Because over 20 years, Yale's VC portfolio returned 77% annually. Here's what you absolutely have to understand. Your VC partner has a fund life cycle, typically 10 years, and faces constant pressure from their LPs to return capital. The fund's age directly affects the pressure you'll face to exit. An early-stage fund has time and capital to be patient with you, but a fund in years 5 or 6 may have exhausted reserves and desperately needs exits. This is why understanding your VC firm's ability to support future rounds matters profoundly. Most entrepreneurs raise money at least once or twice after their initial round, but you don't want to find yourself with great momentum and ready to scale with your venture fund partner not being able to raise their next fund to support you. That's a nightmare. So when evaluating potential venture capital partner, especially if you think you might need additional funding down the road, seriously consider whether that firm will be able to raise its next fund. Do reference checks with the venture community. Talk to other founders and entrepreneurs who can give you a sense of the firm's reputation and performance. Ask about their track record. Understanding your VC's fund age, their capital reserves, and historical returns with LPs determines whether they have genuine staying power with your company or whether exit pressure will intensify as time passes. That's the knowledge that empowers you to make the smartest partnership decision. So, how do the VC firms and their limited partners actually work together? He's direct with us on this. Understanding this partnership structure is critical because it fundamentally shapes how your VC will behave toward your company. So he starts with the basics. When you say limited partner, what are we talking about? It's an investor who has limited governance rights. LPs, limited partners, don't vote on which companies get funded, and they don't control the exits. They're passive investors in what they call a blind pool. But here's the trade-off. In exchange for that passivity, they get limited liability protection. If things go sideways, legally the LPs are shielded, while the general partners, the VCs themselves, bear the risk. Legally, LPs and GPs form a partnership structure, and this matters because partnerships are pass-through entities for tax purposes. Money flows directly to the owners without corporate-level taxation. And this is why university endowments and foundations, massive sources of VC capital, love the structure. They're tax-exempt entities, so the pass-through status is perfect for them. Now, let's talk money, because money is what drives behavior. The Limited Partnership Agreement, or LPA, governs everything financially. First, there's the management fee, typically 2% per year of committed capital. So here's what's important. When a GP closes a $100 million fund, they're not collecting that up front. The LPs commit the capital, and the GP calls it as needed over 3 to 4 years. But that 2% management fee, it's calculated on the full committed amount from day one. That's what pays salaries, office space, operations, everything at the GP firm. And the GP firm is the venture capital firm. The general partners reside there. The real incentive, though, comes from carried interest. That's typically 20 to 30% of profits. So here's an example. Your GP, general partner at the VC firm, invests $10 million in a company that eventually sells for $60 million. That's $50 million in profit. With 20% carry, the GP keeps $10 million, while the LPs get $40 million in profit, plus their original $10 million back. Crucial to understand. The GP might not earn that carry yet. This brings us to something called the J curve. When a GP calls capital early on to invest in companies, the LPs experience negative cash flow. They're spending money. Then years later, when exits happen, they see positive cash flow. The pattern looks like a J on a chart. And here's the problem. Lemons ripen early, as we say. Underperforming companies show their weaknesses quickly, which means LPs are burning capital while holding worthless assets. To value all these portfolio companies sitting in the fund, VCs use one of three methods. There's last round valuation, the simplest approach. There's comparable company analysis, where you find similar public companies and apply their multiples with a discount for illiquidity. And there's the option pricing models using Black-Scholes mathematics. The problem, all three methods can be right according to accounting standards, yet they produce completely different valuations on the same company. And none of them actually predicts what the company will be worth at exit. This matters because if marks show profits that never materialize and the GP has already taken a carry, a clawback might be owed. Finally, let's address the performance safeguards. Some funds use hurdle rates, typically around 8%. The GP only earns carried interest if the fund return exceeds that threshold. Others use preferred return, which work differently. With an 8% preferred return, the LPs get 100% of their money back until they've achieved their return. Only then do GPs participate in profits above that threshold. It's a fundamentally different protection mechanism because it compounds the LP advantage. Both exist for the same reason, to protect LPs against venture capital's inherent risk. Understanding these mechanics isn't just academic, it explains why your VC moves the way they do, how they think about your company's success, and what pressures they're really facing. That's the foundation we need before we look at what VCs actually want from you. So let's continue to talk about this, the return on investment and the incentives that shape your funding partnership. Here's a concrete example that illustrates why understanding venture fund economics matter to you as an entrepreneur. Imagine a $100 million venture fund with a 10-year life and an 8% preferred return to the limited partners. By the end of 10 years, that preferred return compounds to about $216 million. So if the fund generates a total return of just $200 million, the general partner, the firm managing all that capital, walks away with absolutely nothing, zero, not a penny in profit. This isn't some abstract accounting detail. This is the economic reality that shapes every decision your venture partner makes about your company. How fund performance influences decisions about your company. Here's something you need to understand. Financial health of your venture firm's portfolio directly impacts how they think about your business. It's not sinister, it's just how the incentives work. Let's say your venture firm is crushing it with other portfolio companies. They're on track to hit their return targets and raise their next fund. In that scenario, they might fund your next round, even when things look uncertain, because they have the room to absorb the risk. But let's flip that. What if your company is the bright star in an otherwise disappointing portfolio and you get an acquisition offer? Your GP might push you hard to take the exit, even if you think there's more upside ahead. They're not being malicious. They're responding to the economic structure they operate within. Or consider a clawback situation where your GP might have to return money to investors because fund returns are underperforming. An acquisition offer that wouldn't normally excite you might suddenly look appealing to them because it's their lifeline. Understanding this dynamic helps you navigate these conversations with your eyes open. So how do LPs protect their money? Limited partners don't just hand over hundreds of millions of dollars with no oversight. The limited partner agreement, that LPA we talked about, puts specific guardrails in place. First, investment domain. The LP agreement spells out what the GP can and cannot invest in. Maybe it's life sciences, early stage technology, or companies in specific geographies. When evaluating whether a venture firm is right for you, this matters enormously. There's no point pitching your biotech startup to a software-focused firm if their LP agreement prohibits life science investments. Second, the best ideas restriction. This addresses a real conflict. What if your GP sees a phenomenal investment opportunity, but invests her own money personally rather than through the fund? A famous example is Jim Breyer from Excel Partners when he invested about $1 million of his own money for 1% of Facebook alongside his Excel fund's investment. That personal investment returned roughly 1,000 times his money. So modern LPAs typically restrict this behavior or require disclosure. Otherwise, the LPs would have participated in that extra million investment as well. Third, the commitment to actually work. The LP agreement requires that a GP devote substantially all of their efforts to running the firm. If a GP stops meeting this obligation, the LPs can invoke a suspension or force a no-fault divorce and dissolve the fund entirely. So how do GPs work together? In a venture firm, partners aren't always equal. Some have only economic interests but no governance rights, and others have full control. Understanding the structure helps you grasp how decisions get made inside a firm. Partners also split the carried interest, the profits, according to their equity partners agreement. Most vest their carry over time, ensuring they stay committed throughout the fund's life. So why does this matter to you? You can't see these documents, and VCs won't show them to you. But appreciating how money flows inside a fund, understanding the pressures and incentives your GP operates under, makes you a smarter entrepreneur. It helps you understand decisions that might otherwise seem inexplicable. Now that we've mapped out the entire venture capital ecosystem, we're finally ready to talk about the most important piece, the startup, and how you navigate this complex world as a founder. So at this point, he starts getting into the meat, forming your startup. He starts by saying, I know this chapter isn't going to be the most glamorous part of building your startup. We're not talking about your brilliant vision or how you'll change the world, but instead talking about lawyers, taxes, and governance. In other words, we're eating our broccoli. I love that analogy. But here's the thing. This broccoli is absolutely essential, and getting it right at the beginning will save you enormous headaches down the road. He starts with the most fundamental decision. What legal form should your company take? For most startups, the answer is the C corporation. Why? Because it comes down to how the structure works when you're not yet profitable. Partnerships and other pass-through entities funnel earnings directly to the owner's tax returns. Sounds fine until you realize you're reinvesting those profits back into the business instead of taking them out. You end up paying taxes on income you're not actually receiving. A C corporation avoids this problem in those crucial early years when you're running losses anyway. Venture capitalists also insist on C corporations because they allow different classes of stock with different rights. Investors get preferred stock with specific protections, while founders and employees hold common stock. Many VCs invest on behalf of tax-exempt entities like university endowments, which can't invest through pass-through structures without creating tax complications. So a C corporation simply works better for everyone involved. Once you got your legal entity set up, you need to think carefully about dividing ownership among your co-founders. Approach this with what he calls a realistic prenup mentality. The mechanism for this is founder stock vesting. Vesting exists for one reason, to align incentives over time. It rewards founders who stay and build the company while protecting the business if a co-founder leaves early. The traditional standard has been 4-year vesting. But here's what's changed. Companies are staying private far longer now. 4 years used to mean you're approaching an IPO, but today you could still be years away from any exit. This matters enormously because when a co-founder walks out the door fully vested after 4 years, they leave with a significant wealth while you're still grinding to build value. Consider whether your vesting period should actually be longer. You also need to address what happens if a co-founder isn't pulling their weight. Don't make board seats automatic just because someone was a founder. Tie board membership to actual continued employment. And from day one, implement transfer restrictions so departing co-founders can't sell their stock and complicate your fundraising. These protections ensure that equity actually rewards people who build long-term value. Speaking of equity, you need every founder to sign invention assignment agreements, transferring their creations to the companies. The real danger is carrying over technology from previous jobs. The Uber Waymo case is a cautionary tale everyone should know. An engineer took proprietary documents from Google, helped start Otto, which Uber acquired, and Waymo sued and won a $245 million settlement. The lesson is crystal clear. Be extremely careful when transitioning from another company. What feels like reclaiming your own work can become a theft allegation when acquisition dollars are on the table. When you're ready to hire, you'll want an employee option pool. Most founders allocate about 15% of equity here. Options give employees the right to buy stock at a set price. There are two types: ISOs, which are tax advantaged but limited and must be exercised within 90 days of leaving, and NQOs, which are taxed immediately upon exercise. That's a meaningful difference. Here's what's really changed: the timeline to IPO. 20 years ago, companies went public 4 to 6 years after founding. Now it's 10 years or longer. Companies need better equity strategies for this extended journey rather than assuming a quick exit. Plan for a decade or more as a private company and use refresher grants to reward high performers with new stock grants every few years. Get this right, and you've built the foundation for long-term success. So we'll stop here for today. We've covered about half of the book. There are far more details and many more examples in the text of this book. So if this topic is near and dear to your heart, please pick up a copy of the book, The Secrets of Sand Hill Road by Scott Kupor, Kupor. I highly recommend it, and he does a wonderful job of explaining it all in all the gory details so that you can understand it and understand what the pressures will be from a venture capital firm. My advice is always, if you don't need to take investment, don't do it, because you're getting an additional boss or two or three or many as in the process. In part 2, we're going to get into actually how to review a term sheet and be able to tell what a good opportunity for your company looks like versus what a good opportunity looks like for the VC firm. And of course, you have to negotiate to find a point to meet in the middle. And he gives you all the details on how to do that. Anyone building or growing a company today has unique opportunities afforded to them because AI has changed the landscape in every corner of every established business and every startup as well. As a coach and judge for medtech innovator startup companies, I've advised many firms, and I've learned from those firms and advised them on how to achieve their goals. Having come from multiple startups myself, plus companies as large as Fortune 500 companies where I led teams, I have a 30-year base of experience that can certainly help. The gap between where most teams operate and what the next decade requires is real, and I find it for a living. If you want to close that gap, connect with me through www.innoguide.net. Systems thinking, AI integration without added regulatory risk. Embedded ML readiness built from 66 delivered medical products, not theory. I want to thank Steve McIntyre for producing this, and I really want to thank you for joining us. I look forward to seeing you next time for part 2. That's a wrap.